Hello there, you're watching the FinTech Magazine Show, brought to you by FinTech Magazine, InsurTech Magazine and BizClick Media Group. My name's Joanna England, and we're bringing you all the latest news, analysis and opinions from the world of FinTech every month, right here on LinkedIn, YouTube and our other digital platforms. Now, joining me today for our first show of 2023 is, of course, FinTech and InsurTech editor Alex Clere. Hi, Alex. How are you today?
Jo. Yeah, very good. Thanks, Jo. And Happy New Year belatedly to you and everybody watching.
How's your throat feeling? You feeling a bit better?
Yeah, I've got the ills of January, I'm afraid, but hopefully we'll get through the next 30 minutes of FinTech.
We'll do our best. We'll do our best. Now, just a quick reminder for all of you that have joined us to come and say hello and tell us where you're watching from by posting in the comments section below, and also to go and vote in our LinkedIn poll, the results of which we will have later in the show for you. Alex, can you just remind us what the poll is this week, please?
Yes, of course. So after the crash of crypto exchange FTX and the various accusations lobbied against founder Sam Bankman-Fried, we asked you, will the FTX fallout affect long-term confidence in crypto? So it's a very simple one. It's either A, yes, or B, no. You've still got a little bit of time to take part if you haven't already. Just head on over to our LinkedIn page.
Great. And we'll be sharing the results of that poll at the end of the show, but there is loads to talk about before then. So let's kick things off by looking at some of the latest FinTech and InsurTech news. Alex, tell us about your story for this month.
Yeah, so the story I've picked out from the last couple of weeks in FinTech is Butter's raise of $22 million in a Series A funding round. Now, I know Series A rounds don't always get people excited. There is a lot less money involved usually than later venture rounds after all. But I think this one is significant because it plays into a much broader trend within the digital economy. So Butter is a Silicon Valley-based fintech that helps online subscription businesses to reduce so-called accidental churn. In online subscription businesses like Netflix, Amazon, Spotify, a customer gets monthly payment renewals, and those payments keep their subscription active. In most cases, if a payment fails, their membership will end up lapsing. The problem, however, is that accidental churn can happen for several different reasons. The main objective, obviously, is to prevent card fraud, but payments can be declined for something as simple as processor error. So that means the company loses out on customers who actually didn't want to end their membership at all. They might come back and continue their membership, or alternatively, they might just go to a different provider altogether. So Butter has built a recovery engine powered by machine learning that automates payment decisions in real time. The company claims it can add at least 5 points to top-line revenue in every organization that transacts online, making them instantly 5% more valuable. For a company like Netflix, which relies on subscribers, of course, that could prove to be a significant edge. As the cost of living crisis continues to bite consumers, Netflix lost 1.2 million subscribers in the first half of last year alone. So you can see the proof that it's battling to retain subscribers. You know, they're now introducing more affordable products that include advertising. They're finally beginning to monetize features like password sharing, where multiple members of the same family use the same account. So we'll wait and see what Netflix's figures are for the first half of this year, but perhaps businesses like them can start to benefit from Butter's technology. Now, I mentioned earlier how 22 million might not seem like a lot of money, particularly of course, in the context of other fintech funding rounds, which often seem to run into the hundreds of millions. But the company itself says that it is an achievement to raise any money at all in the current funding landscape. According to PwC, total capital investment fell by 60% last quarter. So it's no surprise that Butter founder and CEO Vijay Menon called the Series A investment a, quote, testament to the technology, people, and shared purpose behind his company.
Yeah, and I think that's right. I mean, it hasn't been the best year for funding anyway. So anybody who's getting interest from investors is quite frankly doing quite well. And now we're going to move on to the InsurTech story of the month, which is picked out by me. And I decided to focus on the 5 major trends for insurers to watch out for in 2023. You might agree that they're major trends, you might disagree. There are an awful lot of trends going on at the moment, so, but these are the ones we've picked. Anyway, the first one we've obviously flagged up is the flows of funding, which Alex also talked about briefly in his FinTech news story. Now, demand on investors in the InsurTech space does look set to remain high. But if you have a solid offering, there's no reason why your company wouldn't get the financial backing that it needs. And as we said, we've also seen a lot of funding success over the last couple of months. And that does look set to continue, even though times are a little bit tricky. So yes, it's difficult, but it's not all doom and gloom in any shape or form. The next trend that is looking set to hit 2023 in a big way for InsurTechs are IoT devices and wearables. And this is obviously because technology provides even more precise data so that companies can adjust their premiums accordingly and then pass that on to the customer. And we've seen this most recently with Vitality's Active Life solution. And this uses data from Apple Watches to incentivize healthy lifestyle habits and reducing premiums based on customer results. So we're going to be seeing many more IoT devices and wearables this year. Number 3 is inflation is going to continue to be an issue for insurers. Mainly the impact is that it's going to drive up costs for providers, and then that's going to be challenging for smaller operatives that don't have the capital backing to absorb those rises. As a result of that, actually, the trend number 4 is that incumbents are going to benefit from, in some way, from the inflation situation. And that's mainly because in times of high pressure and stress, customers are generally more likely to seek out providers that have a more trusted marketplace reputation. They're not necessarily going to go to the small operatives. They want to go and take out their policies with a company that they know is going to be able to weather the storm. And the 5th trend, of course, is the cost of living crisis, which is going to continue to force providers to provide more flexible payment terms to make things easier for customers. So obviously, again, things like wearables and IoT sensors are going to be more prevalent, and also things like embedded insurance in products and subscription forms of payment will be seeing more of. Now, if you have noticed any trends that look set to have a big impact this year and we haven't mentioned them, then please do drop us a line in the comments. We might be able to flag those up later in the show if we have time. And also, speaking of the comments, don't forget to tell us in that section where in the world you're watching from, because we will be reading a few of those later on. Now, in a few moments, we'll be chatting to our live guest today. He is Norman Wooding, who is the CEO and founder of the Swiss FinTech Script. He's an expert in blockchain and on the crypto market, and we'll be quizzing him on all things DeFi in 2023. But first, we're going to take a short break, and we'll be back and see you soon.
UWM is a wholesale lender. We are the largest overall mortgage lender in the United States. Jason Bressler, I am an executive vice president and the chief technology officer here at United Wholesale Mortgage. We've got a huge campus and we have all 7,500 of our team members. UWM is all about, in the next 10, 12, 16, 18 months, is growth. We became the #1 mortgage lender with our broker community, and we still, in this high interest rate environment, we still continue to take more and more market share because we're doing such a great job of educating consumers. They use UWM, and so we really want to capitalize off of what we've just accomplished by continuing that growth with amazing tools and great rates and service and speed and all of that. We have such a great opportunity because there's not as much business. People aren't as crazy in doing refinances. Where we are now is we actually have the time, and this is what we've been doing, is educating our clients on just how much of a partnership we have with them and how much we care about them. And that's really increasing our loyalty and our market share. And that's what we're really focused on right now.
So welcome back. Still to come, we have the results of our LinkedIn poll. By the way, Alex, have we got any messages from anyone watching us?
We do, yeah. We've got a couple. It's always reassuring. So thank you for taking part in the chat. Hello to Lauren and Bridget, both from London. Hello to Charity joining us from Zambia as well. And hello to Peter from Kenya. Thank you very much for taking part. And of course, if you've not taken part in our LinkedIn poll, that's over on our LinkedIn page for you still to take part in.
Great. It's good to see people interacting. And now, as promised, joining us today, live in the hot seat, is Norman Wooding. He is the CEO and founder of Script, which is a regulated digital assets and service provider based in Switzerland. Now, Norman has been a tutor on blockchain and cryptocurrencies at the London School of Economics, and he's going to talk all things crypto with us. Welcome to the show, Norman.
Hi guys, thank you very much for having me. Thank you, Joanna. Thank you, Alex.
It's great to see you. So obviously there's been a lot going on in the crypto sphere at the moment. I think we've probably got fairly limited time in which to talk. So I'm just going to launch straight into my questions for you.
Sure.
Okay. So based on really the poll that we're running for the show today, what, in your opinion, what impact has the FTX collapse on general confidence in the fintech space had, do you think?
So there's a lot to unpack there, and I think I would segregate retail confidence and institutional confidence. What it has done is it's given a massive blow to the industry in general. I think more in terms of capital allocation and equity funding than really the adoption, the use cases, or any development of DLT or digital asset use cases or product market fits. So on the retail side, it's definitely dampened confidence because FTX was a retail exchange. On the institutional side, I would look more towards the people who invested around 1.8 or 1.9 billion into FTX and who should have done more due diligence. But I haven't, from my vantage point, seen any slowdown in institutional adoption of crypto in terms of patents, offerings, advancements, CBDCs, supply chain, land registry, financial instruments, derivatives, or otherwise. So it hasn't been fun, especially for someone in the industry. And the reason I say it's a lot to unpack because you could argue that it started with Celsius and it's now beginning to end with Genesis or Genesis Lending filing for Chapter 11 bankruptcy today or earlier yesterday. And what it should bring attention to is a lack of corporate governance, a lack of control mechanisms, malicious behavior by individuals, poor due diligence by investors, and the benefits of actual DeFi and decentralized finance, where these actions wouldn't be possible or permitted under code, but frankly, they are unfortunately permitted under law or under relaxed regulatory and regimes and legal infrastructure or legal oversight. So I can keep going, but I am pessimistically optimistic. Obviously, I'm in the space. I think it's taken a hit. That hit in terms of price has now been priced in. We're moving on. And we as an industry or as a community shouldn't give SBF or Sam Bankman-Fried more spotlight than he deserves. I look forward to the completely legal bollocking that he should and, let's say, merits by DOJ, SEC, and other regulatory and legal authorities in the US.
I think a lot of people are going to agree with you on that one. Okay, so I mean, moving on from that, obviously, it's revealed a lot of weaknesses within the system and things that should have been addressed sooner. So, but moving forward, what trends in the crypto sphere will lead to changes in 2023? What are we going to see that's really going to make a massive difference? So
I think ambiguously or more on a macro level, we're looking at quality and trust. Quality is the quality of the service or the product. Speaking from a trading point of view, for me, that's deep liquidity, tight spreads, not a lot of slippage. From trust, I'm looking at my counterparty. Who am I interacting with? Who's providing me with the infrastructure to access crypto, or who is my counterparty during transactions, custody, or otherwise? Are they regulated, and are they in a jurisdiction which isn't obscure, like the Bahamas, Seychelles, or other offshore jurisdictions? Specifically looking at trends, I really like self-custody. You can see this coming to light because of FTX. You can see a recent announcement by Binance to let institutions trade on the exchange while keeping custody of their assets. So self-custody just means I'm in full control. I have the private key. It's not delegated to anyone else. And if a venue I'm interacting with goes bankrupt or insolvent, then I still maintain ownership of my assets. So that kind of alleviates certain fears brought about by recent events in crypto. There is a saying, not my keys, not my coin, which just pushes and motivates and incentivizes people to control their assets. I know there is a certain gap between what the solution is in terms of self-custody and what the learning curve, knowledge gap, or user experience is. So one big one for me is self-custody. Then we can look at the further institutionalization and standardization of digital assets. We can look to the regulators to come to common agreements. We can look at MiCA, and we can look at FTX as a catalyst to kind of, let's say, begin actual collaboration and not just PR and talks, because I've been hearing about MiCA and different regimes or regulatory oversight for a couple of years. That's why I'm very happy to be in Switzerland. I started the company in the UK, but there was a lack of regulatory oversight. We had the regulatory sandbox license in, I believe, 2017 to 2019. And then you had players like the London Blockchain Exchange, LBX, which went insolvent with customer funds. So that's maybe one reason why I came to Switzerland, because FINMA and the authorities here have been super friendly to crypto for a while. So let's say further institutionalization and standardization, regulatory oversight, self-custody, and then there's some fun stuff like layer 2 solutions, which improves settlement speed and decreases gas fees or transaction costs, and soul-bound tokens, ENS, and then a bunch more exciting stuff happening in DeFi. But overall, as a space, we need to get our act together, and we need to look to regulators and authorities to kind of give that roadmap or structure within which people can operate confidently.
Absolutely, absolutely. And sort of in terms of the whole development of the digital currency space, we are seeing many more countries pilot their CBDC programs. Mm-hmm. What sort of impact do you think that will have on currently running cryptocurrencies, if any impact at all? And is there any kind of indication as to when we're going to see, say, the digital dollar or the digital pound rolled out?
I mean, I'm going to do some public relations or free marketing for some companies here. But if you look at Circle, they have USDC. That's a digital dollar. That's accredited, that's backed, that's pegged, that's functioning, that's institutional, that's 24/7, zero transfer fees, no downtime, no banking cutoffs, instant, right? So that's a really, really good product. That's not a government initiative, so it can't be qualified as a CBDC. I think on the topic of CBDCs, we have two, let's say, communities or two arguments. One is fantastic. It's really pushing the adoption of cryptocurrencies, and you can kind of connect it to self-sovereign identity, supply chain, voting, inherent rights. It can become your online passport in a certain sense. So that's a really good argument from someone coming from a good place, right? And then the second community will argue, and I'm a bit more on this side, is that raises a lot of concerns about private data, information, and confidentiality. So we've seen Cambridge Analytica, we've seen big tech and institutions or large corporations abuse data, and I'm a big fan of owning your data and being in control of your data. So I look forward to CBDCs. It does raise a huge issue around privacy, and then the real question is, how are we going to address that? I would personally advocate for everyone to own their data, and they choose whether or not or who to share it with. And if they do share it, then they gain some sort of economic incentive. Because right now we have big data, it's sold to certain corporations, they analyze it or not, and then they transfer or they sell that to companies selling you products and services as insights and as analytics. So CBDCs are coming. Governments and central banks have been working on them. A few are live, a few are in testnet. And really, we as a society need to push back on the privacy element. So it may force us to further regulate existing cryptocurrencies. It may push or put a certain amount of pressure in terms of innovation and advancement on existing cryptocurrencies, highlight their weaknesses, or it may highlight their benefit in comparison to a CBDC. I would say it's not really about the theory, it's about the execution and the implementation on how it's done, how it's rolled out, how it's distributed, who controls it. Because you don't want to be in a scenario where you are under an authoritarian regime, you vote for something against their interest, and they've locked all your funds or all your cash. Bitcoin was a solution to this, and a response to banks. But if they digitize everything and they still control it, then they can see the inflow, the outflow. They can kind of hunt you down tax-wise. So I'm a bit more libertarian on that side, and I just have to wait to see how it's implemented.
Yes, I'm actually glad you raised that, because I think that side of the conversation isn't something that we often see kind of openly sort of discussed. And I'm also sort of that opinion that we need to be quite careful in terms of how those parameters are set. And I often wonder if a regime brought out a CBDC, would it then force the rest of the population to then gravitate towards much freer digital currencies and use that as opposed to using the government currency? But anyway, we'll just have to see how it plays out over the next 12 months. Now, speaking of which, crypto's had a really not a very good time recently. A lot of people have described the last few months as having been a crypto winter, although I do believe Bitcoin enjoyed a bit of a resurrection fairly recently. Are we actually going to be seeing the end of the crypto winter fairly soon? Are things warming up?
So I would take everything I say with the notion that I have a pure bias because I'm in crypto. And anyone who says it's going to pick up or it's going down or it's going to this price or, they're a self-proclaimed expert, they don't know what they're talking about, because you could not have predicted Celsius or FTX or different black swan events or a tweet from Elon Musk pumping the price or institutional adoption or BlackRock trading ETPs unless you're kind of in the know-how. So I would say, yes, things are improving. I wouldn't necessarily correlate or relate price action and market capitalization to a winter or a summer or a bear or a bull market or cycle. It's important to note that overall the macroeconomic conditions aren't doing too well. We have quantitative easing, we have the devaluation of currency, we have, let's say conflict in Europe, and we have different capital controls and mechanisms, and we have debt ceilings. So it's important to note that, hey, I don't think anything is doing too well at the moment. Crypto, for me, everyday Bitcoin mines a block and doesn't go down and validates transaction is positive and there's a recovery. I feel, and this is a gut feeling, that the FTX situation has been priced in. You can see that Genesis lending filing for bankruptcy hasn't really affected the price at all, because it was priced in and people knew it was coming. We did see a small dip when the DOJ in the US announced that they had a very big, important announcement to do for crypto. And then they mentioned an exchange that I don't think anyone in crypto has ever heard about. So that kind of affected the price. And hey, we're still in such a new emerging nascent asset class that a little bit of money will move the price up and down by a lot, because the market cap is so small. We're still at a stage where the market capitalization of Bitcoin is lower than the banking fines in the past 10 years for money laundering. So my short answer is yes, it's going up. We have yet to see the last domino fall from Celsius to 3AC to Babel Finance to FTX and to Genesis Lending. So we don't know what is left to uncover, if that kind of makes sense. But everyone around me, all the founders are building, they're raising, they keep steadfast in their determination, and they keep building innovative solutions to existing world problems. So yeah, I'm cautiously optimistic. Let's put it that way.
Okay, well, that's good to hear. That's really good to hear. It's some great insights there. Norman, that's all we've got time for right now. We have to move on with another section of the show, but thank you so much for joining us. And honestly, I think, how about we get you back on the show later in the year, and maybe we can look at what's happening then. And,
Hopefully I was right then. Yeah, no, absolutely.
Yeah.
Thank you very much for having me, guys.
Okay, thank you so much. That was great, really great insights there from Norman Wooding of Script. So moving on from the cryptosphere, it's a new year and we've got a couple of new exciting FinTech Live events to look forward to. I want to bring your attention to our next event, which will be a virtual event taking place on Wednesday, 3rd of May, 2023, between 3 p.m. and 7 p.m. UK time. That's 10 a.m. and 2 p.m. New York time. Excuse me. Now, we'll also have some exciting announcements for you regarding speakers and panels in the coming weeks and months for this, but you can book your completely free virtual tickets right now by heading over to virtual.fintechmagazine.com. That's virtual.fintechmagazine.com. And really, to give you a glimpse of what to expect at one of our live events, let's take a look back at our latest hybrid event, FinTech Live London, which took place in November 2022.
Good morning, everyone. This is FinTech Live London 2022.
We're extremely humbled and honored to once again headline FinTech Live right here at the magazine in London.
It's an incredible time to be around the financial services industry these days.
Currently in the UK, we have 6.6 million users of open banking.
What strikes me is the volume of people that are here. You know, incredibly well attended.
The speakers are really good. It's a really good show.
Great venue, great speakers. Couldn't ask for more.
Seeing the number of people and the talent that's here in London is kind of inspiring.
And there we have it. That's what to expect from FinTech Live London, our main in-person virtual event, which will be returning on the 8th and 9th of November in 2023, and also our upcoming virtual event on Wednesday, 3rd of May 2023. So do head over to those links that we referenced and take a look and register your interest. Now, moving on, it's time to look at January's magazines. Our first issues of 2023 are out now. Alex, what can we expect from January's issue of FinTech Magazine?
Yeah, so the January issue of FinTech Magazine is available to read now. Our cover star this issue is Wojciech Łącz, Group Chief Information Officer at Accor Invest. He talks to us about ESG, environmental, social and governance, and why that's at the heart of their digital transformation. At the start of a new year, we also look at the cyber security trends to watch out for in 2023. We explore how cross-border payments are being integrated with other fintech services, such as open banking and embedded finance. And we've also teamed up with Apptopia, the market leader in mobile app competitive intelligence, to get an exclusive insight into the world's most downloaded mobile banking apps of 2022. There are some surprising names in that list, perhaps some surprising exclusions as well. So if you're an avid follower of digital banking and challenger banks, then you won't be surprised to hear that 6 of those 10 come from the same South American country. But in order to find out which one, you're going to have to visit the January issue of FinTech Magazine at fintechmagazine.com.
And of course, thanks, Alex. But of course, because it's January, we don't just have one issue for you, we have 2. And I've got the pleasure of introducing the January issue of InsurTech Magazine this month, because Alex has got a bit of a dodgy throat, but he's doing very well. He's holding his own. We don't want to overuse you, Alex. Now, this month's InsurTech has got a really great cover design. I think our designers have outdone themselves. And inside the magazine, we sit down with the CEO and founder of Instander, Tim Hardcastle, and we talk about his journey into InsurTech. Now, of course, Instander is one of the leading no-code core platforms. And tying in nicely with that, we also have a feature on the rise of low-code and no-code software, which is increasingly being used by the insurance sector to build new products, workflows, and then, of course, launch them at pace. Now, our cover feature this month is all about top 10 venture capital and private equity firms that are investing in the insurance industry. And that would be despite the challenging investment landscape that they find themselves in. So if you're an up-and-coming insurtech and you're looking for some capital love, that is definitely the feature to head over to. But you can catch up that and so much more, actually, by heading over to insurtechdigital.com. Now let's take a look at the results of our poll. It's that time in the show, Alex. Can you remind us of the question and let us know what the results were?
Yes, of course. So our LinkedIn poll for this week was, will the FTX fallout affect long-term confidence in crypto? And we gave you two options, yes and no. And I'm pleased to say that more than 450 people have interacted with this poll. So thank you very much if you've taken part. The results are in, and 70% of people said that yes, the FTX fallout will affect long-term confidence in crypto. Like I said, thank you for your comments on that poll. There are comments underneath saying, there will be an effect, but it might only be temporary. One person has said that, the less well-informed of investors are those more likely to be spooked in the long run, which I think is something that ties into what Norman was saying about the difference between retail investment and institutional investment. So definitely an interesting take there. An overwhelming majority of people think that the fallout from FTX's collapse will have a negative impact on the crypto market in general. Certainly, I've heard from industry observers and commentators in the past couple of months who think that perhaps it won't be the last crypto firm to collapse, although maybe it will be the largest. And we discussed a little bit about that earlier. Certainly, when it comes to crypto as a retail investment, there are customers who've had their fingers burned, if you like, in the FTX affair. So they're probably not going to trust digital currencies again. There are probably also some customers who weren't involved, but they were perhaps curious before, they were thinking about investing in digital assets. Perhaps there'll be a knock-on consequence for those. I think one thing we will see this year is greater consolidation. We know that tougher regulation is coming. That's going to squeeze the industry quite a lot. We also have high inflation and a difficult fundraising environment, like you said. So that's going to push some of the smaller, less financially stable players out of the picture, possibly. So perhaps we'll have some sort of M&A activity in the crypto landscape this year. Maybe those consolidated players will be able to play off a brand image built more centrally around trust.
That's great, interesting results there. Now, I'm sure the crypto industry will continue to evolve during the course of 2023, and we'll definitely see if all our predictions are right. But thank you to everyone who voted in the poll, and thank you for all your comments as well. It's great to get those kinds of insights from the audience. Now, sadly, that's all we have time for in this month's FinTech Live show on LinkedIn. But our next show will be on Friday, the 10th of February. So do mark that down in your diaries. It's exactly 3 weeks' time. Thank you to Alex for joining me today. And thank you, of course, to Norman Wooding from Script, who gave us some brilliant insights on blockchain and cryptocurrency and central bank digital currencies. And thank you also to the production team, who have done a fantastic job today, as always, in producing the show. Happy New Year to you all, and we'll see you next time.